Welcome to this series of videos. In this first video, we're going to talk all about fixed rates. We're going to become an expert on fixed rates, and in the following videos, we'll compare that with variable, and we're going to do very cool stuff so you can know and take decisions on what type of mortgage is best for you. So let's get started. All about fixed rates. This is what we're going to talk about in this video. One, how fixed rates work. Second, who sets the fixed rates. And then 3 and 4 is pros and cons of fixed rates. Most people know the pros, but they don't know the cons of fixed rates. And then we're going to wrap up with a quick summary. So let's get started. How does fixed rates work? A fixed rate mortgage charges a set interest rate that remains unchanged for the term of the mortgage. And if you see here, I select term because the fixed rate is only good for the term. It's not good for the amortization. As I read here, during the term, the payment does not change, but your payment will change throughout the amortization of your mortgage. As you guys know, the amortization is the total length of your mortgage life. So, for example, you may choose an amortization of 25 years or 30 years. So that is the total length that you're going to pay off your mortgage in full, hopefully in less time. But the fixed rate is going to be only good for the first term that you're currently in. Okay. Now, let's look at an example that is easier to digest. If you have a mortgage balance of 100,000, and you have a term of 5 years and an amortization of 25 years, and you choose a fixed rate mortgage for your first 5 years, that will be your first term. Let's say you get a rate of 3%, you're going to be making payments of $473 per month for the first 5 years, which is your term. Now, when your mortgage is up for renewal, the second term, remember that you can stay with the same lender or you can switch lenders if another lender has a better option for you. Okay. On the second term, let's say the lender that you chose gave you a rate of 3.5 fixed. So again, for years 6 to 10, your payment will be $499, and then you'll be already at your year 10th out of 15th on your amortization. Out of 25 on your amortization. And then term 3, it could be 3.2 for payments of $483. Term 4th, 5.1 for payments of $587. And term 5, 2.2 for a payment of $433. Look at term 4 and term 5 interest rates. Term 5 is 2.2. Term 4 is 5.1. So term 5 is roughly half the rate of term 4. But if you look at the payments, it's not doubled. A lot of people get very anxious because they think if their interest rate is going to double, their payment will double. It does not. If you see 433 to 587, it may be an increase of, I don't know, maybe 20%, but it's way far from 100% increase, which will be doubling the payments. So this is an example of a mortgage balance and how it will work if you decide to take 5 terms or 5 years to get to an amortization of 25 years. Now, common terms for fixed rates, 5 years. Don't ask me why. Most banks just offer 5-year terms, okay? But, and this is something that we do if you decide that we are a good fit for you to review your mortgage or to get your next mortgage. We look at your personal situation because other terms may be cheaper or more beneficial for you in some way, depending on your specific circumstances. For example, a 1-year term, a 2-year term, a 3-year term, even a 4-year term. Sometimes 4-year terms are way more competitive than 5-year terms. But you can also choose a 7 or 10-year terms, even though they're not very popular because they're a little bit higher in price or in interest rate. Now, as I said before, you cannot fix your rate for the length of your amortization. You can only do it for the term of the loan. And you can change your term at renewal. So for example, in the previous example, we saw that we did 5 terms of 5 years, but you can choose different terms every time. You can start with a 5-year term and then switch on year 6 to a 10-year term, and then do another 5-year term. So that will be 5 plus 10 plus 5. It's 20 years. And the last 5 years, you can do a 3-year fixed term. And then the last 2 years, you can do a 2-year fixed term. And that will be a total of 25-year amortization. And as I said before, you can do this. You can change these terms throughout the length of your mortgage, and you can decide to stay with the same bank or to go to another lender. You can pick the first term with lender A, term B with another lender, come back for the third term to the first lender, and so forth and so forth. The mortgage market is very dynamic in Canada. Okay, now let's get to the second point. Who sets fixed rates? Okay, very simple. Fixed rates are influenced by the bond market. It's not the government, it's not the banks. They just don't arbitrarily say this is the rate that we're going to give clients. All the banks are influenced by the bond market. Okay, so banks rely on bond yields to finance mortgages. So if bond yields go up, fixed rates go up. If bond yields go down, fixed rates go down. To explain it in another way, the bonds, so for example, if you have a retirement account, okay, an RRSP or any sort of savings, you may decide to save money in a 5-year bond, okay? That's an investment. So you get paid, let's say, 2% per year on that investment, which is a bond, okay? Now, banks usually use those bonds or that money that they get, and they place that money in mortgages. So if the bonds are at 2%, as an example, the mortgage rate will be 3%. So there'll be a 1% increase, out of which the lender will pay off their expenses, they will pay off the broker or their employee at the bank, and they will make a profit, okay? So they basically price 5-year fixed rates with the 5-year bond yields, 2-year fixed rates with 2-year bond yields, and so on and so forth. And as I said before, the government does not set the rates. The bond market influences the rate. So it depends on how much the bonds are paying, rates will increase or decrease, fixed rates. And very important, this last point in this slide, fixed rates change independent of variable rates. So be aware what the news are talking about. There's lots of confusion in the news because people say rates are going up and rates are going down, but they have no idea if it's the variable rates that are going up or the fixed rates that are going up, because they are related, but they're independent from one another. As you will see in a next video, variable rates are set by the government. The government of Canada has the key to the variable rates, but the fixed rates are more an open market type of setup, where, as you see here, bond yields influence the pricing or the interest rates on mortgage rates. So this answers this question on who sets the fixed rates, the bond yields. Now, as I said before, when the bond yields start to go up, the banks see that they're not making money, so they increase the mortgage rates. When bond yields go down, the opposite happens. And this is a picture of what has happened since about 2007, 2006 to today. So about maybe 15 years of rates. As you can see, the blue line is the fixed rates. The orange line is the variable rate, so you can see how they behave. As you can see, most of the time the variable rates have been lower than the fixed rates, but people, as you will see in the next slides, pay a premium for having the fixed rates and having the certainty that their payments will not change. Okay, so this is just a nice picture for you to see what the rates have been in Canada. And as you can see, for more than 15 years, they've been almost 90% of the time under 5%. Okay. Now, what are the benefits or the pros of fixed rates? We all know this. If the interest rates change in the marketplace, your mortgage rate does not change. So you have basically, you can be totally worry-free that whatever happens in the market or in anywhere, your payment on your mortgage will stay the same. Okay, so that's the big benefit of fixed rates. Now, because your rate does not change, you also know that the benefit is that the payment does not change. So the interest rate does not change and the payment does not change. Your only worry is to make sure that you make your payment on time, and your only other worry might be that at the end of the term you will get a new rate and a new payment. So that rate is only good for 5 years. So in a way, this is another way to look at it, fixed rates are also variable rates in the sense that they change every, let's say, 5 years. For every person in Canada, fixed rates are also variable because they will change every 5 years to a new rate depending on what the rates are at that moment in the future. Now, let's talk about something interesting. What are the negatives of interest rates? One big negative, and a lot of people saw this negative just recently. If interest rates decrease, it is very difficult for you to grab these savings. That means to refinance at a lower rate because the lender will charge you a high penalty. So let's say a few years back, we had COVID, okay? And with COVID, the government decided to lower the variable rates, and people saw that if they could refinance, they would save thousands and thousands of people of money because now the rates were way lower. And the rate that they had was too high for the current market environment. But they realized at that time that the lender, to let them go from the fixed rate, they would have to pay a big penalty. And that penalty was very similar to the savings, so it was not worthwhile for you to switch. Or even if you switch, you will not recover any savings. Another negative. So one negative is if rates go down, you're stuck with your higher rate on a fixed rate. Another negative, if your situation changes, for example, you want another home, or you need to change the lender or contract, or you're moving to another province or to another country and you need to pay it off, the lender is not flexible. Again, you will be hit with a high penalty. Okay. Now, when you address these issues with the bank that you're currently with, they will always tell you the following: oh, don't worry, because your contract has the benefit of being transferable, which means, or portable, which means that you can port that mortgage contract to the next property that you purchase, okay? And that way you will avoid the penalty, and it's written in the contract. And that is correct. The small print is that portability is at the discretion of the existing lender. So if you, for example, have a $400,000 mortgage and you sell your home and you want even a lesser amount, $300,000, okay? The bank will only allow that transfer to the next property if everything checks perfectly according to the guidelines. So if they like the property, if they like your new income or your current income and the structure of your income, if they see that you haven't had any issues with your credit history, if you don't have a lot of debt and all their numbers change, and if you have a sufficient equity position, and of course if the property they like and is in good shape. If any of those issues the bank do not like, they will not allow you to transfer your mortgage, and they will enforce you to make or to pay the penalty. So this is very important because portability is not a right. It's an option for the bank to allow you to port that mortgage to the next property, okay? Okay, so these are some of the cons for fixed rates. Now, when because you saw here that I talk about penalties on fixed rates, so I want to disclose that most fixed rate mortgages have a penalty structure where they calculate two penalties. One is 3 months interest and a second one is interest rate differential. When I talk to clients, a lot of clients, and I don't know why or where they get this information from, believe that on a fixed rates they only have to pay 3 months interest. That is incorrect. If any of you listen to this video has a mortgage that is a fixed rate and the contract says that they will only pay 3 months interest, please, I would love to talk to you and let me know that. Let me show me that, because that's going to be unique in Canada, and I would love to learn that over. Okay. All the mortgage contracts from all the major lenders, major banks, credit unions, insured lenders, any lenders, state that is the higher of the two, 3 month interest and IRD. The one that I am more concerned is IRD, which is interest rate differential. Okay, and in most cases, the IRD with most banks can be between 1 to 4% depending on several factors, like the posted rate, the discount that you got when you got the mortgage, the number of months remaining on the term, the new posted rate of the bank at the moment that you're breaking the contract, and the discount that they have at that time. It's super, they make it very complicated to calculate exactly, but on this video I want to disclose to you that most IRDs are between 1 to 4%, okay, of the balance at the moment that you break the contract or that you pay off the contract. So as an example, a $400,000 mortgage that you break or that you pay off before the end of the term, okay, and let's say the penalty is 2.5%, will attract a penalty of $10,000. So you will have to pay $410,000 to get out of that contract or to pay it off early. As you can see, $10,000 is a lot of money. In my opinion, where banks make most of the money is on the penalties, because statistics show that more than 50% of people who have fixed rate mortgages break their mortgage before the end of the contract. Okay, so this is an example on how on what to be aware of on fixed rate, which is the penalty that you should plan your mortgage so the probability that you're gonna pay a penalty or break that contract is close to zero, because otherwise you will gonna be for a big surprise. Okay, there is different lenders that pay different penalties, but in reality, fixed rates have higher penalties than other types of mortgage, like open or variable rates. Now, let's look at a summary. Okay, thank you very much for learning all this about fixed rates. Pros of fixed rates: payment stability during the term and knowing exactly your payment. That's by far the biggest pro of a fixed rate mortgage. Negatives or cons: fixed rates are not flexible. Okay, if you need to change anything on your fixed rates, be prepared for a big penalty, and they can become very expensive, especially if you don't allow that term to go to the end of the contract, or that contract to go to the end of the term. Okay, so those are the negatives. And statistics show that lenders prefer people on fixed rates because it's more profitable for the bank, because it's harder for you to leave the bank, harder for you to go to another lender if there's a better offer. Why? Because the penalties are so big, and even if you go, then the bank will profit big time because of the penalty. This is all about fixed rates. Stay tuned for the next video, which we're going to talk about, or all about variable rates. Camilo Rodriguez at Mortgages Lab. See you in the next video.